Hi, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update. I want to talk a little bit about real estate today and also inflation to your retirement portfolio and why you need to make sure your strategy is in place before you actually need it. A little bit about real estate. Well over 2.5, 3 years ago, I predicted real estate would continue to fall for at least another 2 years. I was spot on in 2010 as real estate continued to collapse, and especially residential real estate. We're also seeing that in 2011 by the numbers that came out yesterday. We're seeing housing start significantly down. We're seeing property values down even further. The bottom line is real estate has more room to go down. Don't kid yourself that real estate is going to bounce back in the next 3 to 5 years. I think we have at least another 10 years before real estate ultimately starts to reverse its cycle and starts to move back up in a positive trend. But even at that, it's going to be a slow grind ahead. So I see 2011, another year dismal for real estate values. I see more people that own homes giving those back to the bank, which is only going to put further pressure on housing, and we have almost no demand for residential housing. The same thing is really holding true for a lot of different types of commercial real estate, primarily retail space, which was grossly overbuilt over the last decade. We still see shopping malls becoming vacant every day, more and more tenants leaving, and businesses going under. What that tells me is you have to make sure that you are in the proper areas for investing. What areas are truly going to grow? What areas are truly going to give you the best opportunity? I want to talk about inflation, which I think is starting to ramp up somewhat. I don't think we're going to have Jimmy Carter Day inflation like we saw 25, 30 years ago, but I do believe we're going to see significantly higher inflation than what the Fed likes, which is around 2.5% to 3%. I think a 5 to 6% inflation factor, as I made a comment a few years back, could be in the cards. I don't think immediately, but I think it's starting to ramp up. Certain asset classes do well in inflationary environments. Certain asset classes will do well in an inflationary environment. One of those areas that will not do well is going to be long-term bonds as interest rates start to tick up. So again, I've talked about this repeatedly. If you took my warning, you would have protected your principal quite a bit on the long and intermediate bonds, whether those are corporate or government securities, and especially on the long-term muni side. I think we're going to continue to see some relative strength in some of the areas in the stock market in the U.S. We're watching the relative strength indicators and our market trend indicators on the overseas market. We're going to be making some significant changes to our portfolio for our clients starting next week, as we are seeing some major opportunity trends starting to emerge. We're going to be talking about some of those over the next few weeks, hopefully on our radio show. Time permitting, of course, with all of our questions. And one of the things that I want to stress is an investment strategy and what you should be doing with your money should already be in place today. The time to have an investment strategy is not when a catastrophic event happens like Japan. You need to have an actual investment strategy and you need to follow it. There will be a point in time, folks, and I can't tell you if it's going to be 6 months from now or 5 years from now, that we're going to go into some other turmoil or major recessionary and the economy's going to tank again. That means equity-based prices are going to collapse. When that happens, if you have a strategy in place to help reduce risk, and if you are following a disciplined strategy, you have a good chance of weathering that storm without significant losses to your portfolio, as you will have switched based upon market trend indicators and relative strength into areas that are stronger and more realistic for that particular time in the investment and economic cycle. And that will automatically get you out of areas that start to become weaker, that become troublesome, especially in severe inflationary environment. Remember, folks, the time to have an investment strategy and the time to follow it is when you don't actually need it. And what I mean by that is, if you're going to do a knee-jerk reaction after your portfolio's dropped 20, 30, 40%, it means you don't have an investment strategy at all. It is so important today to have a disciplined investment strategy and follow it. As always, the Resney Wealth Report will be here live this Sunday from 10 to noon. I hope you do listen in. And as always, if you're finding that your portfolio is not actually being managed, and remember, not all these so-called advisors are actually money managers. Most are just salesmen of investment product. Make sure you understand the difference, because your retirement and your portfolio do depend on it. As always, you can go to my website, resneywealth.com. You can go to the Investor Resource tab and print off the fiduciary questionnaire. Use that questionnaire. That is going to help you in your quest to find actual money management without the conflicts of Wall Street, bank representatives, and insurance agents. Make sure you hire a fee-only registered investment advisor that actually manages portfolios instead of salesmen that sell you investment products that are better for their brokerage house, insurance company, or bank than you. Until Sunday, have yourself an extremely profitable day.